this seems to me to be a good time to get started. One word of advice to you all about the flu. Don't catch it. Even though I had been good and had gotten my flu shot, the virus mutated out from under us and emerged in our household last week in a sufficiently distressing form that poleaxed all three of us, and left me at least with a blinding headache for 5 days, along with fever of 101 and other things, which meant that I rose from my bed rarely, and when I was in my bed, spent most of my time awake and wishing I could fall asleep. This year's flu appears to be bad, and your immune systems are all healthier than mine. I know your bone marrow cells have still their longer telomeres on them and so are more effective at doing what they do. Nevertheless, it's something to avoid. But I'm back, and I'm ready to do now what I hoped to do last Thursday and a little bit of what I hope to do today. So let's get rolling. Logistics, office hours. I missed most of my office hours last week. Today, office hours are going to be 12:30 to 2. After lecture, I'm going to wander on over to the Free Speech Movement Cafe patio because the cafe is overwhelmingly crowded, and shiver in the cold and talk to anyone who wants to come by after I get my coffee. Tomorrow, it looks like 2 to 4 is going to work in Evans 601. If not, I'll email you. There's a chance that yet another recruitment interview is going to be rescheduled and is going to bump into some small share of that time. I'll try very hard to keep that from happening. Let me start with a commercial for the political economy major. You see, over on the north side of campus, we have what used to be the Naval Architecture Building. It has now been revised and refinished and refurbished and renovated and made earthquake safe. And since we no longer have a large department of naval architecture, since we no longer design a lot of warships here at UC Berkeley, the building has been repurposed and is now the Blum Center for Developing Economies. The idea is to make it a space where people can talk about issues relevant to developing economies. One set of such issues is those around the major of political economy. And because right now the university is trying to fill this building with all kinds of interesting activities, I'm going to start running a Friday afternoon at 2 p.m. colloquium series focused largely at undergraduates to kind of get them to come and get some enrichment. To hear people talk and learn what people thinking in this political economy space are currently thinking around here at the university. This Friday, we're going to have 3 people giving brief talks for 10 minutes each. Then we're going to have questions and answers. And then my cousin Marianne McCormick, who is the executive director of the Blum Center, has promised refreshments. Up on North Side on Friday afternoon, we're going to be talking about the political movement calling for economic austerity right now. And I'm going to confess that as an economist, that I'm puzzled. And then we'll have Joseph Lau and Rakesh Bandari from political economy and from interdisciplinary studies, trying to provide sociological and political perspectives on why it is that policymakers right now are so interested in cutting deficits right smack now. Rather than later. Hope you all can come. Problem set 3 is due now, and please write your section time on your problem sets so they can be sorted into the right pile so you have a chance of getting it back. Problem set 4 is due on Thursday, and please write your section time on your problem sets once again. And now let's see if we can get your muscles, your cognitive muscles, up and running again. Last time we had our magic income expenditure equation for figuring out what the level of real GDP in economy was as a function of a bunch of parameters and variables. And here we have values for those parameters and variables. Investment spending at $2 trillion per year. Government purchases at $2 trillion per year. Gross exports at $2 trillion per year. Baseline consumption spending, that part that doesn't depend on income, at $3 trillion a year. An overall average tax rate of 25%. A marginal propensity to consume of 80%. That is, for each dollar that your average household's after-tax disposable income goes up, consumption spending goes up by 80 cents. And 10 cents of every dollar spent on imports. What's Y going to be? Okay, we're still all spread out. We hope you'll get less spread out as time passes. I think the right answer to this is going to be B. And let me check. Yeah, it looks like it's B. It's 18 trillion. How you get this? Well, when confronted with a problem like this, where you're in a situation of depression economics, when unemployment is elevated and when the economy's big problem is that there's too little demand for currently produced goods and services, because something has gone wrong and households and businesses think that they have too little in the way of financial assets and are trying to build up their financial asset stocks. And as they try to build up their financial asset stocks, they've cut back on their purchases, and they keep cutting back on their purchases until they feel so poor that they throw the idea that they should be building up their stocks of financial assets over the side. If you're confronted with that situation and you want to know at what level of real GDPY the economy is going to come to rest, you simply write down this particular equation, which Marty Olney and I derive at excessive length in the book, which I derived here long ago. But the important thing is not to be able to repeat the derivation. It's simply to notice that there are 4 components flowing into, say, autonomous spending, 4 components of spending that don't depend on income that you need to keep track of. Those are the 4 things that go on the numerator of this equation. Baseline consumer demand spending, consumer spending on goods and services, that part of it that's baseline, that doesn't depend on income, but simply depends on consumer confidence. Businesses spending to expand their capital stock and increase capacity. The government's purchases of goods and services. Note that this doesn't count when the government simply writes checks. When the government writes a Social Security check or an unemployment insurance check or that doesn't count as government purchases. Writing of that check goes into the determination of this little variable t down here of this tax rate. This tax rate parameter t is affected by the balance between the taxes the government collects on the one hand and the checks to individuals the government writes on the other. Conceptually, this tax rate's the difference between the two. And then gross exports, purchases by foreigners of goods made in the United States. Those are the 4 things that go on the numerator. We had 3 trillion plus 2 trillion plus 2 trillion plus 2 trillion for those 4 things, which gives us 9 trillion. The denominator are what economists call these multiplier terms, because once you add up their entire impact, they turn out to multiply the effects of changes in these spending flows on overall output. In order to figure out what the multiplier terms in the denominator are, you take a look at the marginal propensity to import, the share of spending spent on imports. Because if we spend on imports, that doesn't put people to work here. That puts people to work in Singapore and Malaysia and elsewhere. We said that was 0.1. We look at our marginal propensity to consume. We said that was 0.8. We look at our net tax rate, T. We said that was 0.025. Take 1, subtract this mess from it, and you get 0.5, which means that the 9 trillion flow of baseline consumption plus investment plus government purchases plus gross exports is multiplied by a factor of 2 and gets us 18 trillion worth of GDP. That's the kind of calculation we want you to do. And indeed, that's the kind of calculation that was one of the first things that our very own Professor Christina Romer did back in November 2008 after the election, when she went to work for Barack Obama as chair designate of his Council of Economic Advisors. The first question asked her was, we're now in a depression economic situation. The financial panic has caused businesses and banks and individuals to start to scramble to build up their cash because they don't know what the future's coming. How far is the level of real GDP going to fall if we do nothing? And what should we do in the government in order to fix this? And she began running through these calculations, although with a much bigger staff and at a much more complicated and sophisticated level. Not just one dependence of consumption spending on income's term, but a whole bunch of them. Not just one number for investment spending by businesses, but a whole bunch of spending for different components of businesses on investment. In the end, she got the answer wrong. That is, her estimate of how bad the recession was going to be, of how large the fall in real GDP was going to be, turned out to be about half of what we actually got. That she wound up underestimating the scope of the problem by 50%. But she was out there, she tried, and she was drawing on the stuff that we want you to be able to put on the midterm as at least a first pass, a first cut at her analysis, which turned out to be remarkably key toward figuring out what the state of the American economy is right now. More logistics. We have our assignments for All the Devils Are Here, the book about the financial crisis. You're supposed to be reading and discussing in section. And we want you to have finished that book not before the first midterm. The book won't be on the first midterm, at least nothing except the very early portions of the book will be on the first midterm. But it will be on the second midterm, and we want you all to have finished it before spring break. Recapitulations, once again, remind you of the things we want you to know. We really want you to know how much bigger total GDP is now than it was at the start of the invention of agriculture. We really want you to know that the seasonally adjusted unemployment rate is currently 9%. Although that seasonal adjustment part makes me nervous. I took the Bureau of Labor Statistics estatements of unemployment, seasonally adjusted and unadjusted, and I backed out the seasonal adjustment component for each month going back to 1990. This last point here, for example, this is the minus 0.8. Meaning that the actual unemployment rate that the Bureau of Labor Statistics current population survey reported for the survey conducted over the first 2 weeks of January was that 9.8% of the labor force was unemployed. The Bureau of Labor Statistics then subtracted 0.8 percentage points from that, saying that's a seasonal factor. That's because the month of January sees fewer people employed than on average. Snowstorms, shutdown of Northeast construction, lots of businesses lay off people after the Christmas rush and haven't yet started about putting them on again. We're going to knock it down by 0.8% to try to get an estimate of what the underlying unemployment rate would be if we didn't have this little seasonal cycle in economic activity that we do. Problem is that only 3, 4, 5, 6 years ago, that number was 0.4%, not 0.8%. That back in 2006 and 2007, the Bureau of Labor Statistics took the January survey result and knocked 0.4% of it off rather than 0.8%. Why does it knock 0.8% off? Well, unemployment right now is about twice as big as a share of the labor force as it was back in 2006 or so. And you might say that when the unemployment rate's higher, you'd expect seasonal fluctuations in unemployment to be higher. And as Justin Lahart of the Wall Street Journal was arguing to me last week, that's a fair point. But twice as big? Would you expect businesses to lay off twice as many people and to the shutdown of construction because of snowstorms to affect twice as many people now as it did back in 2006 just because the unemployment rate is twice as high? I think twice as big is too large. This doesn't mean that I know what's right. Certainly, if I could figure out what's right, the people at the Bureau of Labor Statistics, who are just as smart as I am and are working a lot harder on this than I am, would have done something different. But the seasonal adjustment factors make me nervous. My bet is that as this seasonal adjustment factor diminishes as we move into the spring, that we're going to see the seasonally adjusted unemployment rate rise a bit. You all got the last time I asked that there can be deficient demand for pretty much every single good and service in the economy. If people want to build up their financial assets as a group, because people spend their incomes not just on currently produced goods and services, but on financial assets as well. And so Say's law that there couldn't be deficient demand in the economy as a whole is just not true in general. You got the last time I asked this that this was the equation that you needed to remember for doing problems with respect to long-run economic growth, which you'll next see on the mock midterm. And we already covered in this lecture the magic equation for dealing with depression economics, for trying to figure out what the level of output spending and incomes in an economy is going to be if the economy is in a situation in which the unemployment rate is relatively high. And that gets me through the preliminaries and up to where I can talk some more about the income expenditure model that we built up last time, the conclusion of which, the payoff to which, comes in this particular equation right here. Their income expenditure model has three pieces in it in its most basic form. The first is simply the adding up constraint, the definition of GDP, the circular flow principle. The idea that if you're in a depression economic situation, the total level of production, of incomes, of spending in the economy, those are all Y, those are all going to be the same because of the circular flow principle. That the best way to calculate that is to look at what households are doing in terms of spending on consumption goods, on what businesses are doing in terms of spending on investment goods to add to their productive capacity, on what the government is buying, and then to look at the difference between exports, what foreigners are buying that's made here in the United States, and imports, what the U.S. persons are buying that's made abroad. Why the minus imports? Well, because to the extent that the consumption spending of households here is spent on imports rather than on domestically produced goods, it won't show up as any income for American households because it won't show up as demand for anything produced in America. So that's the first part of the income expenditure model. The second part is this behavioral relationship that tells us what household consumption spending is going to be as a function of economy-wide incomes, Y, and as a function of the taxes, the tax rate T that the government levies on incomes. So that you take Y, total income in the economy, multiply it by 1 minus T, you get the actual after-tax incomes that households have available to spend. And then how much of that do they spend? Well, they spend a fraction CY, the marginal propensity to consume of that, buying currently produced goods and services. They then add to that this consumer confidence term, an extra amount of spending that households spend because they feel relatively optimistic about the future or whatever. Add those two pieces up, and you get consumption spending by households on currently produced goods and services. That's what households do with their disposable income. The rest of it, they take off and they try to buy financial assets with it. Now, once again, this isn't a rule, this isn't a law, there isn't a machine buried in the earth somewhere sending out tachyons or whatever that affect our brains and that cause us all to spend, so that consumption spending is actually equal to some C0 variable that you can measure that depends on consumer confidence, plus CY, some marginal propensity consumed that you can directly measure, times disposable income. Instead, this is a rough emergent outcome of the behavior of 130 million households, each of which has their own income, each of which has their own expectations about the future, each of which has their own ability to borrow or not borrow, and hence to increase spending when income goes up and decrease it when income goes down, or to keep spending the same when income goes up or down. That the bet that we economists are making is if you take the actions of all these 130 million households and add them all up, and then mash it together, that we will get a fairly systematic, fairly constant, fairly predictable relationship between consumption spending on the one hand and income on the other, that the marginal propensity to consume for the average of households won't wander around too much. And when it does wander around, we had better be able to see it wandering around as well in what people surveyed by the University of Michigan say when the University of Michigan asks consumers, how confident are you? This could be a really lousy equation. This could be a really lousy way of trying to think about the determinants of consumption spending. It's certainly a very simple way. We're going to run with it for a while, and if we have time, we'll go back and we'll look at exactly how good an explanation or a way of accounting for consumption spending this is. Similarly, for our simple assumption that imports are going to be proportional to real GDP, with this parameter telling us what the constant of proportionality is. That's the result of decisions to import goods and services made by tens of millions of firms, and then decisions to buy the imports are not made by more than 100 million households. We can't model this at any more detailed level. We can't replicate all 130 million households in an economic model, let alone describe what each of them is doing. Indeed, a perfect model of what a household is doing or what an economy is doing would almost by definition have to be as large and as sophisticated as the economy itself, and in some sense would be the entire economy. The hope is that we can approximate the actual behavior of the economy as a whole in those limited aspects we're interested in right now by these two very simple behavioral relationships, that we then combine that with this adding up circular flow identity, and that then we can then use that to make calculations and to carry out what-if exercises in order to figure out how the level of spending, output, incomes in the economy is going to react to changes in economic conditions, the economic environment, and economic policy. And in order to do that, we use this equation here. That's what economists do. That's what using an economic model is. That's what Christy Romer in the Transition Office found herself doing in December 2008. Writing down this equation bunches of times and doing sensitivity analyses on what different assumptions made, because there is no CY that she can look up in a book. She had to estimate her own. That's something that I think is very much worth doing. It leads to a better class of thought and analysis of what's happening to the economy. But it's not rocket science. It's a much more crude exercise, although I do think quite a useful one. So let's do another such useful exercise. Here we have the same equation. Here we have some different parameters, different imports kind of propensity. An open economy in which 26.7% of spending is spent on imports rather than the 10% we saw before. Say a different number for baseline consumption C0, it's up to 4 trillion rather than 3 trillion. Otherwise, they're the same numbers we'd had before. What does boosting baseline consumption spending while at the same time you up the marginal propensity to import? What does that do? Does that get you to 20 trillion? No, that's not going to get you to 20 trillion. And that's not going to get you to 20 trillion because changing the marginal propensity to import has a fairly big effect on what happens. That is, the people who said 20 trillion were right in doing the right calculation for the numerator. Right? You have 2 plus 2 plus 2 plus 4, that's 10. If your denominator and if your multiplier were still the same. If the import sub y propensity had been the 0.1 it was in the last problem rather than 0.267, you'd have gotten the right answer. But an economy in which a whole bunch more spending is spent on imports is one in which consumption spending goes up, and you find that people aren't buying things made in Toledo, Ohio. They're buying things made in Vancouver. And so this doubling of the numerator that we got isn't there. Instead, the numerator goes up by only 1.5 times, only up to 15 trillion. And so that's what we're left with. That's the right answer. Nevertheless, 20 trillion. 20 trillion's a good answer, especially in 30 seconds when you haven't seen this before. And we're only giving credit on this one for clicking, not for getting the right answer. That tells you a fairly important thing about how the economies respond, which is that the more an economy trades, the less effective are going to be changes in what's going on inside itself as far as spending flows in determining the effects on production and on employment. Yeah?
I just have a question about
Yeah.
the value of C. On the last slide, it said it was 0.25,
Yeah.
and it's inputted as 0.05.
That's called a typo. Sorry, the decimal point is supposed to be... I can't edit it here. Sorry, that's a typo. I'll correct it on the slide. That's simply that's called simply a mistake. An error. Yeah. This is why you'll find that countries in Europe are a lot less enthusiastic about the government taking steps to try to boost their economies when unemployment is high and when production is low than we in the United States are. That what your average politician in Italy or France or Germany, let alone Switzerland or the Netherlands, says is that, okay, we take steps to boost government spending or to expand or to make guarantee loans or whatever. Then we have the debt that we have to tax people to repay. We have the obligations that may come due and that we may have to taxpayers to repay if something goes wrong. But who benefits from all the extra jobs created by this extra spending or by these loan guarantees? It's not just our citizens. It's the citizens of Spain and Italy and Switzerland and France and Germany as well. It's not like the United States where the benefits from stimulative economic policies flow to American citizens and where the taxes rest on American citizens. Although even here, most of the benefits of stimulative spending programs go to people in states like Nevada and California, and people in Nebraska, where the unemployment rate is currently 4% or so, won't see much benefit from stimulative programs, and hence their senators are very unwilling to vote for them. That a nearly closed economy like the United States is one that's going to have a bigger multiplier term. Something that would take 10 trillion to 20 or 25 rather than from 10 trillion to 15 than in Europe. And so you'll find the United States much more aggressive in pursuing economic policies to try to restore stability and full employment than your average European country. Of course, this was supposed to be solved by the creation of the European Union, which was supposed to create a European-wide central bank, a European central bank that would manage the European economy in the interest of the community as a whole, which has sort of worked. The European Central Bank is hinky in a number of aspects. And there was also supposed to be a bunch of centralized fiscal decision-making, which simply has not happened, and which puts Europe in a relatively bad position to deal with downturns like the one we have now. So I've shown you the income expenditure model in algebra. Now let me try to run through the income expenditure model in words. It's that the circular flow principle tells us that there's economy-wide income on the one hand, and there's economy-wide production and spending on the other. And that whenever spending is less than income, and people are trying to build up their stocks of financial assets, well, what happens when spending is less than income? It's that businesses see their inventories rising, and when their inventories are rising, they say, wait a minute, we shouldn't be making so much stuff, we can't sell it. They fire workers to try to match production to current sales, and those workers lose incomes, and as those workers lose incomes, they cut their consumption spending down, and so the gap between income and spending doesn't go away. Just because incomes have fallen, because spending has fallen too. And the process repeats, until incomes have fallen so low that spending is no longer less than incomes, and households and businesses, are no longer trying to add to their holdings of financial assets. That's the income expenditure model in words. Some people prefer algebra. Right? That rather than try to run through the chain of words, they'd say, what's the equation? Here's the equation. We simply plug the number into the equation. We get the right answer. We get a good grade on the midterm and on the final. I don't want people to just prefer algebra, to just do the algebra all by itself, because the key is not just to have this equation close enough to the forefront of your brain that you can write it down and produce an answer. The key is to know what the equation means, to know why to apply it and when and what conclusions to draw from it. Like, should the government then go out and take lots of steps to make businesses happy in order to try to get businesses to expand their investment spending? For example. If the Treasury Secretary talks about how a strong dollar is in America's interest and the dollar goes up in value as a result, well, won't that shrink gross exports? Because if the dollar is stronger, U.S. products will look more expensive to foreigners and they'll buy fewer of them. Is this really something we want to do? You can't use this equation intelligently if you don't also understand the words, the verbal description that's behind it. On the other hand, if all you can do is say the words, you then have a very hard time getting quantitative answers of any sort. And we're economics here. We like to get quantitative answers. We like to be able to say it's not just that there's going to be an economic downturn. We'd like to say that the economic downturn is likely to carry real GDP down to 8 or 10% below its normal trend level. And even though Christy Romer said 4 to 6% instead of 8 to 10% back when she did the calculation. At least if you're trying to do the calculation, you have a chance of getting the order of magnitude right. If you don't try to do the calculation, you're absolutely nowhere. So I'd be as unhappy if you just know the words as if you just know the algebra. And then there are still others who prefer graphs. That I guess it was René Descartes back in early 17th century France, who who came up with this bright idea that you could represent equations by lines and points where equations intersected, the solutions to systems of equations, of two equations, as the point on a graph where two lines crossed. And that you could move back and forth between algebra and geometry in this way. And so understand things both in terms of symbols and visually, and it was very much the same thing. And we can do this. We can do this with the income expenditure model too, and we economists do. And we start by simply drawing a graph with an x-axis and a y-axis. And we put the same variable, in this case, on both axes. We put y, real GDP, on both axes. Except that the vertical y is spending. How much it is that households are spending when you add together net exports plus government purchases plus business investment spending. The horizontal axis is income. How much businesses are producing and then paying out to households in incomes, counting retained profits by businesses as if they were credited to the households that own the businesses. And we do this because the circular flow principle tells us that these two variables are the same, that spending's the same as income. That's why we use the same variable y for both. The circular flow principle tells us that we can draw this graph, but the economy is always going to be on this 45-degree line. This 45-degree line, which is the set of all points in which spending is equal to income, in which the circular flow has reached a kind of stable or metastable equilibrium. And that allows us to say, well, gee, you could think of a whole bunch of places where the economy might be, but the only places where the economy will ever be on this particular blue line. This particular blue line is thus a representation of this circular flow principle, that everyone's spending becomes someone else's production, and every act of production by a business becomes someone's income, and in the end, the income ultimately becomes someone's spending as well. And so then, after having established that the economy is going to be on this blue line, that is the circular flow principle, we drop that for a second, and we say, suppose that incomes were zero. How big would spending be if we didn't have the circular flow principle to worry about? And the first thing we say is, well, even if incomes in the United States were zero, we'd still be selling exports. So we take the amount of gross exports that we expect. And that puts us right up here at this point. I'm hard on the y-axis with an x-axis of 0 and a y-axis value up here. But that's not the only component of spending. There's also investment spending by businesses. Even if income were zero, businesses would still be saying we should probably add to our capacity in the long run. And so to gross exports, you add business investment spending, which gets you up to here as your level of what spending would be if incomes were zero. And there's a government. There's a government as well. The government presumably going to keep on conducting its occupations and would do so even if income is zero. Add that, and you're up to here for spending. And then you can add the fourth and last component of baseline autonomous spending, this consumer confidence part, the amount of money that households would spend even if they had no incomes at all. That'll get us right up to smack here. Would tell us if there were a world in which we didn't have to worry about the circular flow principle, and if incomes were zero, here's where, what do we do then? Well, then we look at the terms by which spending does depend on income, and which production does depend on spending. We say for each dollar that incomes go up, well, after-tax incomes go up by 1 minus $t, And so consumption spending goes up by this CY, this marginal propensity to consume, times 1 minus T dollars. That tells us how much consumption spending goes up for each dollar that income goes up. But then we're interested most in spending on domestically produced goods. We're interested in gross domestic product, not in the effect of incomes on world product. So we have to subtract off the share of each extra dollar of spending that goes to buy foreign goods, that goes to buy imports. Take the effect on consumption, subtract the effect on imports, and you get the slope of this particular red line here. So what is this particular red line here? This red line here tells you what spending will be as a function of income y if the circular flow principle does not hold. It tells us what if you add up the behavioral relationships and the adding up condition for the definition of total spending in the economy as a whole, how spending would vary with income. And then you look at where that line crosses the 45-degree line. And you know the economy is going to be there because we know the circular flow principle holds. That tells us where the economy is going to be. The economy is going to be right there with that level of income and with the same level of spending if gross exports, if investment, if government purchases, if baseline consumer confidence-driven consumption are what they are, if the marginal propensity to consume and the tax rate and the propensity to import are such as to give you this particular slope. In drawing this graph, drawing this line, looking where the curves cross, where the kind of Keynesian income expenditure line crosses the 45-degree line, you've performed in geometry the same kinds of algebraic manipulations that led us back to this equation here. They really are the same thing. This is simply that relationship in symbols. This is simply that relationship in algebra, only in symbols. We had these symbols with their numerical values standing for themselves. Here we have little line segments corresponding to each one. In symbols, we had the multiplier terms here. Here the multiplier terms are the slope of this particular line. And if you're good enough and have a steady hand and have enough graph paper, you actually don't really need the algebra at all, as long as you know how long the lines are corresponding to these four components of spending, as long as you know what the slope is, and as long as you're able to draw graphs with a steady hand. I do it when I don't understand what might be going on. I don't recommend it for quantitative calculations. None of our hands are that steady. Nevertheless, if you've noticed in your Economics 1 course, in other economics courses you've taken, there are a lot of graphs, and there are a lot of places in which the economy is where the curves cross. Lots of places ask you to draw supply and demand graphs, and then do the algebra on the side, and then label the points on the graph by their numerical values that you've calculated. The idea is that this reinforcement of symbol-based kind of learning on the one hand and graph drawing on the other is a significant aid to understanding. That you do it in words, you do it in algebra, you then do it graphically, and so you get 3 points of view on the material, that they reinforce each other, and you get a much firmer and sounder grasp of the material as a whole. This was what Nobel Prize-winning economist Paul Samuelson thought when he set the mold for our current set of economics textbooks. This was the curriculum he developed just after World War II. Problem is that Paul Samuelson was teaching at MIT and was teaching in the immediate aftermath of World War II, when all of his students were 23 and 24-year-olds who'd just spent 3 years fighting World War II and were going to college on the GI Bill. And anyway, they were at MIT, which means that they were even a hair above Berkeley engineering students in terms of their comfort level with analytic geometry and with moving back and forth between equations and graphs on the one hand and on the other. So you may well find that the graphical stuff is confusing rather than an aid to your intuition and a help in understanding the material. If so, that's absolutely fine, right? If you want to run with the algebra and the words alone, that's fine. If this stuff isn't helping you understand it, don't sweat it a great deal. It's not that urgent. It's not that important. It's there simply because if you were an MIT sophomore in 1947, you already live, breathe, and sleep analytic geometry. It's your natural mode of expression. And so drawing the graphs was a way for Paul Samuelson to get his students hooked more into the subject. I find that that's true for about half of Berkeley students, that for about half of them, this Keynesian cross diagram and supply and demand diagrams are a true help to understanding economics. And for the other half, they're a kind of pointless visual ritual they have to go through, which leads them to make wrong answers more often than right answers. And they never quite get what's going on when someone says, oh, and the consumer surplus is the area of this triangle here, that they'd rather people just didn't say that. It's confusing. Either way's fine. But you ought to see this. And economics textbooks are, as you're aware, filled with things like this. Now, one more point about the income expenditure model. I started by saying that the breaking of Say's law, right, that remember back in 1803, Say had given this plausible argument that you really shouldn't have to worry too much about a situation in which the economy had too little demand for everything. That you did indeed have to worry about sectoral shifts, about there being too little demand for meat and too much demand for textiles. Or in Berkeley, too much demand for cafes latte and too little demand for yoga lessons. And thus yoga instructors having to undergo the painful process of getting retrained to make lattes without getting burned or whatever. But that, Say argued in 1803, you really wouldn't have to worry about an economy that was way short of demand. Yet here we have one right now in which demand is 10% below its trend growth rate, and as a result, our unemployment rate is 4 percentage points higher than it would normally be. And we said that the hole in Say's argument was that he didn't think about how people took their incomes and wanted to spend them not just on currently produced goods and services, but on building up their holdings of financial assets as well. And then having said that, I kind of more or less dropped that and went off into talking about how consumers want to spend and how much businesses want to spend on investment goods and how much the government wants to buy and so forth. And you should have been thinking, wait a minute, how does all this spending tie into this excess demand for financial assets stuff? Where did that go? And the answer is that's still there. It was somewhat hidden. That suppose we start by saying that everyone is that already somebody owns every single financial asset, every dollar bill, every bond, every derivative security, every stock, every real estate investment trust. Somebody holds it right now. But as time passes, more financial assets are being created as kind of businesses and the government spend and issue bonds and stocks, real estate investment trusts and other things. And demand for financial assets is also likely to grow as households save stuff and go looking for financial assets to buy. Suppose we say what needs to be the case for the supply of financial assets to be equal to demand, for people to plan to acquire as many financial assets as business and the government are creating. Well, the pace at which businesses and the government are creating financial assets is simply the pace at which businesses are spending on investment goods, the pace at which businesses are adding to their capacity. They've got to get that money somewhere. It comes from either retaining earnings and so boosting the value of their stock. That's creation of a more valuable financial asset. It comes from issuing bonds. It comes from borrowing from banks, which then need savings deposits in order to fund that. That business investment spending creates financial assets. And when the government runs a deficit, when government purchases G are greater than net taxes T, the government prints up huge honking tranches of bonds and sells them off. And so that creates financial assets as well for people to hold. What's the flow of savings? Well, you take what households' incomes, Y, you subtract the taxes that households pay T, you then subtract the amount that households spend on consumption spending on currently produced goods and services. That's Y minus T minus C. That gives us how much households are saving, how much they want to add to their stocks of financial assets. And then you've got to subtract off net exports. Why do you have to subtract off net exports? Well, if net exports are negative, that means that we are importing more than we're exporting, which means that we're paying foreigners a bunch of dollars that they then aren't turning around and using to buy U.S.-produced goods and services to then take it back to their countries. What are they doing with these extra dollars that they have? Well, they can't eat them. They could wallpaper their rooms with them, but they're not going to do that. Instead, they're going to take those dollars and they're going to buy some property or buy some financial asset in the United States. They're going to invest it in America. So the total flow of savings into financial markets is this domestic term and then this international term as well. So from this, we simply see that when people plan to acquire as many financial assets as businesses and the government plan to produce, when there's no excess demand for financial assets, then the pace at which businesses and the government plan to create financial assets, this thing on the left, is going to be equal to the pace at which domestic households and foreigners wish to acquire financial assets. This stuff on the right. So as a result, balance in the market for financial assets. Not having to worry about there being upward or downward pressure on the economy as a whole because there's no imbalance between demand and supply of financial assets. That holds true if this equation holds true. And then we play with it. We take a look at this equation. We notice it is a minus tax term on both sides. We simply cancel it out. We notice that we have other things on the right-hand side besides real GDP Y, and we'd like to get rid of them. So by adding net exports to both sides, we can move this net exports term from the right over to the left. We notice we then still have a consumption on the right-hand side, and by adding consumption to both sides, we can move this C from the right over to the left. And when we do so, we get this thing, Y equals C plus I plus G plus net exports, which we've seen before, which is our adding up condition for real GDP. So what this tells us is that whenever there's no excess demand for financial assets, then Y equals C plus I plus G plus net exports, that people's plans are consistent, that people are then planning to spend on currently produced in goods and services what is actually being produced, and so there's no upward or downward pressure on consumption, on consumption and on GDP. And that tells us that when we went all the way back to here, when we wrote down this adding up condition for what real GDP was, that already incorporates into it the idea that the economy is at a stable position, that there's nothing pushing production up or down when Y equals C plus I plus G plus net exports. So that this Say's law principle, that the economy will be in a stable position when there's no excess demand for financial assets, we put that in there at the very start, when we first wrote down the definition of GDP at the start of our dealing with the income expenditure model. That's where it went. That's where it is. It is in there. Okay. And why is this so? Well, this is the circular flow principle, right? That, as John Stuart Mill and Jean-Baptiste Say said back in 1829, an excess demand for financial assets is a deficient demand for currently produced goods and services, and thus our equation for businesses being happy with what they produce, for spending being equal to income, and for no big unexpected and unwanted changes in inventories. This is also our equation for no excess demand for or no planned excess supply of financial assets. That brings me to the close of the income expenditure part of the basic economic model for depression economics. Now we're going to want to peel it back a little bit further. That is, we have one equation for what the level of real GDP is as a function of multiplier terms and these baseline investment flows, C0, IG, and gross exports. We're going to want to peel it back and say we don't want to just have the flow of investment on the one hand and of exports on the other given to us. We're going to want to analyze situations in which the determinants of investment spending and of gross exports themselves are going to change. We're going to want to start from this equation here, and we're going to say we don't want to assume we have to know what this I and what this GX are in order to solve our model. We're going to want to be able to calculate what they are by looking deeper at what their determinants are. And we're also going to start looking at changes relative to baselines. Is we're going to start putting big Greek letter deltas, these triangles resting on their base, in front of pretty much everything. We're no longer going to be talking about whether the level of real GDP is 15 trillion or so in equilibrium. We're going to say if X happens, then the level of GDP will drop by 500 billion or so. Why are we just going to look at changes relative to some baseline growth path? Well, two reasons. The first, if we do so, we can have simpler formulas because we can drop out terms that do not change. And we're going to have complicated looking equations, and if we can simply say this doesn't change, this is a zero, all of a sudden our equations will become comprehensible. Second, whenever we're dealing with depression economic situations, there is in the background this underlying long-run growth trend from the growth economics section going on. And having to incorporate that into our calculations would raise them to another order of complexity we'd rather not. We'd rather assume that there is some growth trend baseline path back there, and we are just interested in deviations from it. That is, we're dividing the state of the economy into a trend part and a business cycle part, and we just for a while want to look at only the business cycle part. And we put these Greek deltas in front of everything to stand for change and to stand for difference between the level of this variable and its smooth growth path long-run baseline. And I'm also going to want to say that this baseline consumption plus investment plus government plus gross exports term, I'm sometimes going to want to call this by the big letter A. A standing for autonomous spending. Autonomous meaning that it's spending that doesn't depend on the level of real GDP. It's spending that doesn't depend on the level of income, and it doesn't depend on the interest rate. Because we're going to want to find what the level of income is, and so having some of our variables that we're looking at depend on income would be annoying, and because we're going to want to vary the interest rate, which means we're then going to want to divide up components of spending into those that do vary with the interest rate and those that don't. And for those that do vary with the interest rate, we're going to want to call those baseline autonomous spending, A sub 0, kind of like we called those parts of consumption that didn't vary with income baseline consumption spending, C little 0, with 0 counting as relative, meaning that it's some baseline quantity. And also note these little things with subscripts that we've been using for a while. C sub y and IM sub y. This is kind of a convention that helps keep things slightly less confusing. Whenever you see something with a subscript, it's going to mean that it's not itself a variable that moves, but rather a parameter that tells you the responsiveness of something. What's the responsiveness? Well, this CY is the responsiveness of consumption C to changes in after-tax income. This IMY is the responsiveness of import spending to changes in after-tax income. Keep that in mind because there are going to be a whole bunch of such things flying around the screen fairly quickly. So we have our C0 here in autonomous spending determined by consumer confidence. We have this G, this government purchases, determined by politics. And the tax rate T is determined by politics too, but it doesn't change nearly as much. What determines investment spending by businesses? And what determines gross exports? Those are the next things that we're going to want to tackle. Well, to put it in brief, investment spending, we're going to say, is determined by two things. First, by business confidence. How confident are businesses that they'll be able to sell stuff they make if they build up their factories? Or are they terrifically depressed? And B, how expensive is it for them to borrow and invest? Or perhaps how attractive is it for them to take the cash they have and lend it out in financial markets rather than spend it building up their capacity? And for that, the cost of capital that really matters to businesses is the long-term risky real interest rate R. Is the interest rate you have to pay or that you receive when you make not short-term 3-month investments, but long-term 10-year investments. A real interest rate, not a nominal interest rate. That is, we're not interested in the number of dollars that you get from loaning or that you have to pay back when you borrow. We're interested in the number of commodities or the value of commodities, which means that we want to subtract the rate of inflation from whatever interest rate is quoted to us by the bank or by the bondholder in order to figure out what its real inflation-adjusted interest rate is. And we're not going to be looking at the interest rate on safe investments because businesses are not safe things. When they invest in a factory, who knows what things are going to be like 5 or 10 years down the road. If you make a risky investment, you expect a higher rate of return, a higher interest rate. And if you are a borrower that's itself risky, you have to pay a higher interest rate in order to borrow. We're interested in those risky interest rates rather than the interest rates on safe government bonds. So we're looking at the long-term real risky interest rate R as a determinant of investment spending. And for exports, the other component that we're interested in, well, those are determined by foreigners' incomes and by the real exchange rate. This script E, this epsilon, this value of domestic currency relative to foreign currencies, again adjusted for changes of inflation. this thing that determines whether the products that we tend to make are relatively cheap or relatively expensive in the world as a whole. So we're going to write down our equation for investment spending, and it's going to have a delta in front of it because we're interested in looking at changes or at differences relative to some long-run economic growth baseline. And it's going to be delta investment spending. And the first term is going to be this I0 term, this business confidence term. This term that says that businesses will spend more when they're more confident about the future. That's what the 0 means. It's a baseline that depends on confidence. And then minus this I sub r delta r term, minus the sensitivity of business investment spending to the real long-term risky interest rate, times the deviation of the real long-term real interest rate from whatever your baseline is. Why the minus? Because when interest rates go up, it's more expensive to borrow, and businesses' investment committees are more likely to say, we shouldn't undertake this increase in our capacity. Look at how much we'll have to pay in interest in order to finance it. When interest rates go up, business investment spending goes down. How important are these two things? Well, they're about equally important. That the Federal Reserve has, since late 2008, been trying to do a whole bunch of things to try to diminish, decrease, and minimize this long-term real risky interest rate. That the Office of Management and Budget, more when it was headed by Peter Orszag in the first year and a half of the Obama administration than now when it's headed by Jack Lew, who has less of a high profile, that Peter Orszag was all about going around and talking to businesses and saying that, yes, the Obama administration has a plan for getting the long-term future of the American economy back on even keel by balancing government spending and taxes over the long run. You, Ms. Businessmen, shouldn't worry that if you invest in a factory now, we'll impose confiscatory taxation on it in 15 years to pay for Medicare. We're going to actually do something to slow the growth rate of Medicare. So your confidence can be high and you can invest a lot in adding to your capacity without worrying that that value will simply blow away and disappear. Those are the two determinants of business investment spending we're going to write down. And once again, it's not as though there's an investment equation buried in the soil somewhere. That this is a simple, rough approximation to a complicated process involving tens of millions of businesses, each of which is undertaking its own decisions to invest or not to invest, and so add to its productive capacity, or not add to its productive capacity. The hope is that if we get a handle on three aggregate magnitudes, business confidence on the one hand, the sensitivity of the average business to changes in interest rates on the other, and the long-term real risky interest rate, we'll be able to do a good enough job at modeling and predicting and tracking business investment spending to have some quantitative conclusions come out that are actually worth something. So here we have it again, the change in business investment spending on the left, the change in business investor confidence in the first, the sensitivity of business investment to the interest rate misspelled on the second, and the change in the interest rate relative to baseline on the third. That's going to be our investment equation for this course. If we were my teacher, Olivier Blanchard, and if we're using Olivier's textbook, there'd also be an accelerator term in there having to do with the level of real GDP. Because Olivier rightly says that businesses are much more willing to invest when the overall level of demand is high, and when they know they've got lots of customers. We're not including that here just to make things simpler. It might be there in the background. I'm not going to ask you about what would happen if that effect is important. We just don't have space. Besides investment spending, we also have gross exports, which we said depended on the exchange rate. And then we got to ask what determines the real exchange rate. That is the value of the home currency, the value of the dollar. Well, the value of the dollar in terms of foreign currency right now is determined by a whole bunch of people. We used to call them the burghers of Amsterdam. Then for a while we called them the gnomes of Zurich. The British government especially would denounce the gnomes of Zurich that were pushing down the value of the pound and embarrassing it. There were a couple of stories that financial reporters wrote in the 1960s which claimed to be interviews with an actual gnome. Nowadays they're on Wall Street, on Canary Wharf in London, in Frankfurt, in Tokyo, all over the world. The biggest speculator on foreign exchange right now is the single organization called the People's Bank of China. And the level of exchange rates in international currency markets is set by what these particular bunches of speculators are willing to pay for different currencies. And in general, you can say that it depends on two things. That the real exchange rate, the value of the home currency, is determined by the average of speculator confidence in the long-run value of the currency, and on the difference in interest rates between home and abroad. And why is this so? Well, it's a balance between fear, optimism, and greed on the part of all of these people. The fear part. If your currency is high relative to its long-run baseline, it's not going to stay high forever. It's going to come back to normal at some point. That means that if you invest in it now and hold it for a year and then sell it, you've got to fear that it will come back to normal during the year that you've held it, and you will take a very large capital loss. So that's the fear part. That if your value of your currency is high, it might go down. Then there's the optimism part. Right? If you believe the future is bright for the dollar, you'll be willing to pay more for it. Then there's the greed part. If interest rates at home are higher than interest rates abroad, say here in the United States, where long-term real risky interest rates are on the order of 5% per year, as opposed to Japan, where they're on the order of 1% per year. Invest your money in a United States bond, and you make denominated in dollars, you make 5% per year. Invest it in a yen bond, you make only 1% per year. That's about 4% per year in extra money. If you're greedy, you'll say, I want to buy dollars and invest my money in the United States in order to get that extra return. That's greed. That's fear. If the value of the dollar is high, the fear can be counteracted by optimism. And this parameter here, this sensitivity of the exchange rate to changes in the real interest rate, that's the balance term. And the way these fear, optimism, and balance and greed terms are all going to work out is that the deviation of the exchange rate from baseline is going to be equal to this term that depends on speculators' relative optimism, plus the sensitivity of the exchange rate to the interest rate times the gap in interest rates you get between holding your money, holding your wealth at home, and holding your money abroad. And let me stop there, and I'll go over this again at the start of the next lecture.